Today I will talk about the fundamental theorem of asset pricing. I'm going to do a theorem. A theorem in math, as you know, is a statement which we make, which is true always. A brief review of something we already saw. This is the basic framework that we're going to be using for this. We're going to be using a securities universe that will consist of a number of securities whose costs or prices we know in advance. We're going to use the index I to denote these. There will be securities with a certain price today or a certain cost given by a vector Q. What I'm going to be doing today is good for a finite number of securities as well for an infinite number of securities. I will focus on the finite number. It's going to be easier to deal with. But if we were dealing with an infinite number of securities through some additional mathematical complexities, we can deal with that. Where possible, I will try to express what is needed to extend this to the case of infinite number of securities. Okay, but for now, we're going to assume the number of securities that we observe is finite, given by a number capital N. Could be very large, could be very small. We saw the case of 2 in the case of a stock and a bond, and this would be extended to the case of many stocks and a bond, and other possible securities. And in this context, a portfolio is a vector. Mathematically, a portfolio will be a vector of finitely many components if I have finitely many securities, or infinitely many components if I have infinitely many securities. In that case, we will require an additional property, which is that the total weight of the portfolio is finite. Or in other words, as it's called in mathematics, that the portfolio as a function is in L1. Normally what we actually need is L2, but being in L1 will guarantee that we're also in L2, because all the weights would have to be smaller than 1. And each security will have a payoff given by a random variable. So now what we have here is, now this starts to look a little bit like algebra, because if we, on the one hand, for all the securities we are dealing with, each of them will have a random variable as a payoff. If the number of states in our probability space is finite, then what we're looking at is an actual matrix, as we saw earlier. For the case of a single security, the payoff is a whole column vector, and then we organize all these column vectors together to get us all the rows for the different events that could happen, and the result will be a matrix. We saw the payoff matrix in the past. Now we consider the payoffs as a vector of random variables, as a random vector. It's exactly the same thing. We're just giving a mathematical formalism to things we already saw. Everything we're seeing here is known. And omega is the terminology we use to denote the possible individual events that could happen within our measure or probability space. Again, nothing new. I'm just giving mathematical formalism to what we have seen before. This formalism will allow us today to construct the whole framework of a pricing theory. Okay, in the case of finitely many observations, what we have is a payoff matrix, as we saw in the past. Okay, payoffs. A payoff is a random variable. We're going to denote this random variable by letter P. Note that this is the payoff now not of the securities that we observe, but a payoff is any given random variable. It denotes any possible future payoff we may obtain. Back to our example, back to our 33-cent example, there we had 2 securities and 2 possible events, a bond and a stock, and the stock going up, the stock going down. Okay, of course, each bond and each stock has their own payoffs, But then we came up with a new one that was the option payoff. If the stock goes up, I give you $1. If it goes down, I give you nothing. So that is a payoff that is introduced. It is not a payoff that is linked to the securities that exist. Now we know that this payoff is the linear combination of the payoffs of the securities given. We're going to extend, we're going to generalize exactly the same concept. And for that, we need to introduce the concept of a payoff as a general random variable. We saw that a complete market is one in which every payoff is in the linear span of our securities payoffs. But still, I want to distinguish now between the payoffs of the securities given and all of the payoffs that might exist, and in particular, the payoff of a particular derivative we may want to price. Again, nothing new. I'm just giving a mathematical formalism to things that we already saw, at least in the case of specific examples. In the case of infinite measure spaces with an infinite number of events, we will further assume that payoffs will be in L2. In other words, they will have finite expectation for their square. I'm not going to put a lot of emphasis into these additional abstractions, but for those of you who may be interested in going into the infinite dimensional space, this is worthwhile. And for some applications, this is something that we also need to take into account. Markets will be complete when the span of all of the basic payoffs, the payoffs correspond to the securities we observe in the market, gives us all the possible payoffs we're dealing with. So with this notation, I deal with a finite probability case in which every random variable is square integrable, and also the case of infinitely many possible events in which I restrict my attention to payoffs whose square is integrable. Given a payoff P, its price will be denoted by capital Pi of the payoff, and that is a linear function of the payoff. So again, back to our example, the payoff was a random variable equal to, for example, 1 if the stock goes up, 0 if it goes down. The price, which turned out to be 33 cents in our previous example, is something which is a linear function of the payoffs. If I have different payoffs with different prices, if I did linear combinations of the payoffs, the prices will also be linear combinations. We're looking at a linear problem. Okay? And again, nothing new. These are things that we already saw, and we even saw in abstract form earlier in some cases. In the case of infinitely many securities, the price will not only be a linear function, it will have to be continuous. And for those of you who understand functional analysis, this is what a functional is. This is of interest when we go to situations where the number of events and the number of securities is possibly infinite. In this context, a state price deflator is a convenient random variable which helps us discount future payoffs with the following framework. For every portfolio denoted by a vector theta, its price will be determined by what? By the expected payoff modified with this random variable. Now let's pause here and look at this expression in some detail. Let me go back to the situation where I had a stock that could go to $2.50 and an option that will give us $1 when the stock goes up and nothing when it goes down. In that situation, if the probability of the stock going up is 50% and the probability of the stock going down is 50%, if we apply expectations, the price of the option would be 50 cents. We saw that the real price is not 50 cents, the real price is 33 cents. If we price the option at 50 cents using expectations, we are mispricing the option. What we're doing today is we're going to modify the payoff with a random variable so that the expectation would give the right price. It looks like cheating. In a certain sense, it's a convenient way of cheating. It is a type of cheating that will allow us to get the right answer. And that is the purpose of this state price deflator. The state price deflator will help us discount future cash flows with a probability given that might be wrong, might be not risk neutral, and yet it will give us the right price if we use this modified version for the expectation. This is the purpose of this. Think of this as a convenience that we can enjoy so we can calculate prices based on expectations. This is always possible. We just need to modify the probability measure as a function of this random variable given by the letter pi. We'll see examples of that later.
Professor Sego,
Yes.
can I think of this pi as like a probability density, the correct probability?
So it actually, if you understand what I'm going to tell you now, let me just go back here. Sorry. There. The right, let's see if you understand this. Pi will be the radon-Nikodym derivative between the real world measure and the risk neutral measure. Do you understand that?
Yeah.
So you have seen the radon-Nikodym derivative, yes?
Yeah.
Good. That's what it's going to be. So it is a density. It's actually more than a density. A density sometimes is a radon-Nikodym derivative. It's what allows you to go from one measure to the other. That's what pi is going to be.
Okay.
Okay?
Thank you.
Good. All right. I will discuss this towards the end of this section. Today I'm doing two sections. I'm finishing this and I'm starting something new. I will be discussing this in some detail towards the end. So when I...
So, can I ask a follow-up question?
Yeah, of course. Go ahead. Yeah.
So pi is going to be a radon-Nikodym derivative. Typically, you need two measures which are absolutely continuous. So are we going to define the other measure, or are we just going to define pi and then define like the other measure to be the given one times pi?
That's okay. So we can do it in either way. Today, we're going to be doing it by defining the correct measure, the risk neutral measure, using pi. However, in the past, we defined the risk neutral measure as the one that gives us the right prices. Remember, we were calculating the the measure that will price the stock and the bond correctly, and then we concluded that then that's the risk neutral measure and that will price everything correctly. So you could also, not today, but you could also do the risk neutral measure directly by finding the one that prices the stock and the bond. In that case, pi will be the radon-Nikodym derivative. So you can do it in either way. You can define, well, you don't have to define the real world measure that's given to you. That's the 50-50 that's given to you. Then you can define the risk neutral measure as we did last week. And then pi would be the radon-Nikodym derivative. Or you can do it invoking the fundamental theorem of asset prices that gives you pi, and then you construct a risk neutral measure using pi as the density that goes from one measure to the other.
Okay, thank you.
Yes. Now, this is a very big deal what we're doing today, to the point that many courses are devoted exclusively to developing these theories. And back to what I said the first year of classes, I am not going to do that. This course is not about depth. I could spend a lot of time on these fairly wonderful mathematical constructs that give us the theory of prices in single period, as we're doing today, and in multi-period and even continuous time period. That is not the approach that I'm going to do in the course, but I did want to at least show you how this theorem works. In the case anybody's interested, you can continue on that journey on your own. Okay, there's a lot of interesting mathematical objects here. I don't do this in this course because this is not going to get you a job. A few decades ago, this might give you a job, not today. Okay, still, it is a very valuable perspective on the existence of prices, and that's why I will devote half an hour, probably an hour, to doing this today. There are many ways of approaching what we're doing today. They're all the same, they're all consistent with each other, but today I'm going to follow the direct route in which I will construct the state price deflator, and the consequence of this is that the risk neutral measure will arise as a function of the state price deflator. So I'm constructing the density, and then I construct the risk neutral measure. I don't have to construct the risk neutral measure first and then do the random-Nikodym derivative. The second part to your question, which is also good, you mentioned that the two measures have to be absolutely continuous. I don't know if everybody understands what I'm saying. It's not a problem if you do not understand, but it is very important if one does the risk neutral measure and real world measure approach that the two have to be absolutely continuous. The implication of that for us is very clear. It's very clear. And let me put it into, I'm going to say this just because of your question. It gives me a platform to mention the following. Imagine the following. I said that if we play the 33-cent game, if the stock goes up, I give you $1. If it goes down, I give you nothing. I said that that is independent of the probability of the stock going up and the stock going down, correct? That's what I said. And we went through that, and I convinced you of that. Well, I did a small exaggeration in doing that. Imagine that the probability of the stock going down is 0. Then the argument we developed actually breaks down. If the probability is 0.0001, it works, but if the probability is 0, it will not work. Then the system of equations we have is inconsistent, and it won't work. This is significant, not to the point that I wanted to highlight it in my course. It's one of these things which are important, but I tend to just fly over. But since you asked the question, I will now have to say that the absolute continuity is important. And if in the 33-cent game I am going to suddenly attach a probability of 0 to one of the events, then the argument will not work. Either to the stock going up or the stock going down. If the probability of either of those is 0, then it won't work. The reason is that now I have a real world measure and a risk neutral measure, which is always going to be a third, two-thirds, always going to be that, who are not absolutely continuous with respect to each other. And that's where it breaks down. And then I suddenly have an arbitrage opportunity. Okay? Now, yeah, so that's the second. It's a good question. It's a good question, and to give you the full answer to the question, I'll have to give a whole new course. Okay? I'm not going to do that, but I think you probably get a sense of where these things would go and how these things could be dealt with. And then you have to deal with a lot of exceptions and a lot of very precise definitions. And the result is a beautiful construction. It's a beautiful building that you can construct with all of this. Today, I'm just going to show you the very tip of it. That's it. Is that clear?
Yeah, absolutely.
Yeah,
Thank you.
but it's a good question. It's a very good question. Okay, so back to this formula. The price of a payoff, the price of a portfolio. Sorry, the price for every portfolio, we have a price which will be given by the expected modified payoff, so to speak. Okay. The impact of pi is to modify the payoff. in this manner. So in this expression, let's analyze this in some detail. Theta is a vector of numbers, a real vector. D is a random vector. It'll have columns, and each column represents the payoff of a certain security, which is a random variable. It's a random vector. So the product of D times theta, in this case, you can think of it either as a dot product of a random vector times a vector, or a matrix product if you write it down as a matrix. Your choice. And then finally, we have a random variable, which is our state price deflator, is the multiplier that is going to change the weights of the probability so we get the right price using the wrong probability distribution. Is that clear? That's the significance of the state price deflator. It modifies the real world measure given to us so that it essentially works to give us the correct price using expectations. The theorem we're going to prove today is a theorem that says that this state price deflator exists and has certain properties. That is the purpose of what I'm doing in the first half of today. In this context, we have the efficient market hypothesis, which is that there are no arbitrage opportunities and no transaction costs. We buy and sell at the same price. No one is making money. That's the efficient market hypothesis, and it's a convenient hypothesis to develop theories. In this context, the fundamental theorem of asset prices says that efficient markets have a state price deflator, always. Moreover, there are no arbitrage opportunities if, and only if, the state price deflator is always positive. In other words, if you had a way of calculating the state price deflator and it's zero at some point, that will indicate the existence of an arbitrage opportunity. This is very useful information, because if there is an arbitrage opportunity, this tells you where to look for it. And if markets are complete, the state price deflator is unique. That's the theorem. Let's go to the proof. The proof will be done in two steps. First, we will prove that if pi exists and is positive, then there are no arbitrage opportunities. Then we will prove that pi must exist. This is the if and the only if parts of the argument. Let's start with a simple one. Step one. Assume there is an arbitrage opportunity. I want to prove this by a contradiction. If there is an arbitrage opportunity, theta, this is a portfolio that will give me a non-negative payoff with a not positive price and a strictly positive probability that it will give me something positive. That's what an arbitrage opportunity is. But since the price of this portfolio is going to be given by the expectation of the modified payoff, we see that the payoff of the portfolio being positive and pi, the state price deflator, being strictly positive, makes a contradiction that the portfolio price is not positive. It has to be positive. Pi is positive, and the probability that the payoff of the portfolio being positive is positive, and the payoff is never negative. The combination of these three statements makes it impossible that when you multiply this by a real valued function which is positive, obtains something which is zero or negative. That's not possible. That's the contradiction. So we have proved that if pi exists and it's positive, then there can be no arbitrage opportunities. We did this by showing that if there is an arbitrage opportunity, we have a contradiction. Conclusion, there are no arbitrage opportunities if pi exists and is positive. So that's the easy part. Let's go to step 2. This is the one which is a bit more involved. Assume now that there are no arbitrage opportunities. Our objective is to come up with the state price deflator pi. For that, we're going to imagine, we'll denote by the letter L, the vector space of all possible payoffs. And to that, we're going to consider the augmented vector space of all price payoff combinations, whether they come from a portfolio or not. In other words, I consider the Cartesian product of the real line representing all possible prices, and on the other hand, we multiply by the vector space of all possible payoffs. Payoffs are vectors.
Okay, so we're allowing for negative prices?
I'm sorry? Yes, we allow negative prices. Yes, of course.
Like, you will pay me to take it?
No, a negative price, for example, imagine that I play a game, which is when the stock goes up, you give me $1, and when it goes down, you give me nothing. Then the price will be minus a third.
Okay.
Yep, I'm not saying here, note that I'm not saying here that the payoffs are positive. Here I'm dealing with all possible payoffs. Positive, negative, combination. If the stock goes up, I give you $1. If it goes down, you give me $1, for example. That's a payoff. And a price is any number. A lot of the combination price payoff will not correspond to any portfolio. That's okay. I'm not saying that they correspond to portfolios. Right now I'm considering the augmented vector space of all possible payoffs, of all possible derivatives, of all possible securities, of all possible portfolios, and all possible prices. They may not be related by a portfolio. Okay?
Yeah, got it. Thank you.
And now what I do is, this is where the finance comes in. Now I consider the hyperplane of the following, and this goes to your question in a certain sense. Consider now the hyperplane given by the following. On the first coordinate, on the real coordinate, I consider the negative price, the negative cost of all possible portfolios. And on the second component, I consider the payoff vectors of the same portfolio. In other words, whereas the vector V, the vector space V, is the augmented payoff cost without a relationship between the payoff and the cost, the hyperplane is the relationship between the payoff and the cost. They have to come from the same portfolio. That's why it's a hyperplane. It's going to be a sub-vector space of codimension 1, but that's not important for us right now. I'm taking the negative of the price as opposed to the price just for convenience reasons. You will see. I could have taken the price and the payoff, but then I have to modify the next geometric object I'm going to construct. What I'm going to be doing now, the proof that I'm going to give you, is a geometric proof. And in the construction of this geometry, my first step is to construct this hyperplane. Negative price and actual payoff. By negative price, I mean the negative of the price of a portfolio and then the payoff. If the portfolio has a negative price, the first component here will be positive. I add the negative sign to the first component. So that's a hyperplane. Then I consider the cone. A cone which is given by the following, is the Cartesian product of all first components which are positive and all payoffs which are positive. And again, this need not come from a portfolio. I'm not saying that. The hyperplane comes from portfolios. The hyperplane is a financial construction. The cone is not. It's a purely geometric construction. I look at all vectors whose first component is positive and whose second component, being a random vector, is always positive in any one of the events that might happen. Every component is positive. Every occurrence is positive. As a random variable, every outcome is positive. That's what I denote with the sub-index plus. Okay? I have a cone, it's purely geometric. I have a hyperplane, it's purely financial. Now, the absence of arbitrage implies that the intersection of this cone with the plane is the origin. Only the zero portfolio is there. Why? If there was anything in the cone and in the hyperplane, that would be an arbitrage opportunity. It's something that has a positive payoff and a negative price. So absence of arbitrage implies that the intersection between the cone and the hyperplane is just the origin. In other words, what I have done here is I have a geometric characterization of the concept of absence of arbitrage. The efficient market hypothesis here states that the intersection between the cone and the hyperplane is the origin. In other words, this is a geometric expression for the efficient market hypothesis. Let me show this as a picture. I start with my vector space. Here I did a picture in dimension 3 because that's the only picture I can do. It doesn't matter which component is price and which components are the payoff. Not important right now. The construction, the geometric construction, is somewhat independent of the cost and the payoff. That will become relevant when we move into the financial interpretation of this geometric construction we are doing. So my vector space V has a hyperplane in it, denoted by the letter M. Here I did a hyperplane that seems to be the XY plane. That's not important. I'm just doing a geometric construction. Where this hyperplane is not important. And then there's a certain cone, which I denote by K. The cone is also not financial, it's purely geometric. And we have seen that the absence of arbitrage condition as a consequence says that the intersection between the cone and the hyperplane is just the origin. So it will look like this that you have in the picture. And at this point, what we do is we realize that in this situation, I can construct a linear function, continuous linear function, that will map my vector space V onto the real line linearly, with the characteristic that it will send the hyperplane to the point 0, and it will send the cone to the positive real line. Let me pause here and say some remarks about this. I don't know if you have seen this theorem in this form before. Geometrically, using your intuition, this theorem is obvious in finite dimensions. What is it? One would say it's the projection onto the orthogonal to the hyperplane if you use our intuition. If you project the space V onto the orthogonal to the hyperplane, as you have in this picture, the hyperplane obviously goes to the origin, goes to 0. And the cone, where does it go? It goes to, in this case, the positive real line. So intuitively, it should be clear. This statement I'm writing here is somewhat intuitive if you just imagine the geometry. It can be proved using elementary linear algebra, but here's the interesting part, and this is for those of you who will understand my statement. If you don't understand this statement, relax, don't worry, it's okay. But it'll give you a sense of the depth which is behind what I'm talking about today. If you're in infinite dimensions, this theorem is not at all obvious. In a Hilbert space, if you know what that is, it's doable, it's not hard. In a Banach space, however, it's actually quite deep and complicated. Everything that I'm talking about here can be done in a Banach space. And the interesting part is that this theorem in the Banach space is called the Hahn-Banach theorem. Some of you may have seen that. Graduate students in mathematics would have seen that. A Hahn-Banach theorem is actually equivalent to the axiom of choice, which is one of the big mysteries that mathematics had around the year 1900. In fact, it was one of the problems listed by Hilbert in the famous Congress of Mathematics in the year 1900. I think it's actually problem number 1. I'm not completely sure. But this was an open question in the year 1900. Hilbert did not know the answer to this question. And now here it comes in the context of pricing securities when I have infinitely many securities and probability spaces which contain infinitely many possible events. The existence of this function is equivalent to the axiom of choice. Okay. Again, it's a statement for those who understand it, just to give you an idea of the depth of the concepts we're dealing with here. Coming back to our situation of finitely many securities and finitely many possible events, although possibly big, this theorem is somewhat intuitive. It's just the projection of space V onto the orthogonal complement of the hyperplane M. Is that clear? So equipped with this, I will derive the functional calculus we need to express what we're saying here, and I'll express in words what I expressed earlier in pictures, which is by the separating hyperplane theorem or the Hahn-Banach theorem. In infinite dimensions, there exists a linear continuous function which maps the space V, the augmented payoff space, into the real line with the condition that every point that belongs to my hyperplane M goes to 0, and every point which is in the cone but not the origin goes to a positive point. So as you can see in the math, I corrected my simplified expression in the picture. Now both are correct. Now, what's the big deal about this? The big deal about this is that with this function, we can do many things. A linear map that sends a vector space onto the real line, if it's a vector space of finite dimensions, is a vector multiplication in finite dimensions. Or, in the case of infinite dimensions, is the Riesz representation theorem, for those of you who know what that is. Either way, both express exactly the same thing, which is that a linear map that sends a vector space into the real line is the inner product against a vector, against a fixed vector. In other words, there exists a vector in my vector space V. My vector space V contained two components, the first representing price, the second representing payoff. The first I call alpha, the second I call phi. These are constant vectors in my vector space, such that my function is the dot product against this fixed vector. Note that here I'm using the Hilbert space characteristics of my payoff space. In other words, if the payoff is thought of as a matrix, I'm using here the multiplication of a matrix by a vector. I still call it using the notation of inner product common in Hilbert spaces, or in the case of finite dimension, using the notation that we use to multiply a fixed vector times another vector. Okay? So any vector VC in my vector space will be mapped by the function f to a point which is alpha times the first component times the inner product of the second component times my vector c, fixed vector phi times my variable vector c. And this is true for all points in my vector space. Since the inner product in my space, the multiplication of matrices times vector, corresponds to a probability, what this is the expectation, that dot product is the expectation of the product of my fixed vector phi times my parameter vector c. In other words, my linear function is the dot product of alpha times v plus the expectation of the product of my payoff vector phi, fixed vector phi, times my variable vector c. Since f of my hyperplane goes to 0, that means that if we apply this expression to all of the payoffs and prices that arise from real portfolios, what I have is that for real portfolios theta, this function f goes to 0, which means that this expression that you have here is equal to 0. And now we are done, because with this expression being equal to 0, what I conclude is that the price of my portfolio is going to be the expectation of the payoff theta times the payoff matrix modified by the division between the fixed vector phi given by my linear functional f divided by the fixed number alpha. The fact that my function sends the hyperplane to the origin means that this expression that we have here is equal to 0, and sending the first term to the other side, where I conclude is that the price of any portfolio will be the expectation of the payoff, denoted by portfolio dot product payoff matrix modified by the division between the fixed vector phi divided by the fixed number alpha, both of them arising from the bridge representation version of my linear map between my vector space and the real line, which in turn came from the separating hyperplane theorem, separating my cone and hyperplane. The result of this is that the state price deflator what we're looking for is the division between that vector, that random vector, divided by the number alpha. And that concludes the proof of the theorem.
Sorry, Professor Seiko, I have a question.
Yes, go ahead.
So the linear mapping that you chose, the linear map F,
Yes,
was just any linear map that satisfied that condition.
any of them.
But you stated that this function pi is unique. How did you prove that? So this function pi would be unique then?
Okay,
Because
so
the linear map F wasn't unique.
yes, so the uniqueness of the uniqueness of the random variable pi, you can think of it in two different ways. One is from an arbitrage-free perspective. This function, what it does is it gives you the right price of every possible security, and if you had two different pies, so to speak. So for specific events, they give you different values. Then what you would do, I have to assume that markets are complete. What I would do is I would take the payoff, which gives me, for example, 1 under that particular event and 0 otherwise. And then I would have that event will have 2 different prices under 2 different state price deflators. Okay, it's quite obvious. I didn't write it down. You see? That's one.
Yes.
The other one, which is a little bit more elegant, is that in the next slide, I'm going to show you that this pi is actually the random nicotine derivative, and the random nicotine derivative is unique. Okay, so you can have your mathematical proof or your financial proof, your choice. For complete markets, pi has to be unique. And you understand, right? If pi, say,
Yes.
it differs if in one point you have 2 different pi's, then pick the option that gives you 1 under that event and 0 otherwise, and then you have 2 different prices. Okay, this requires a little bit, I mean, this is the simple answer to your question. Some other person may be listening to me and say, wait a minute, if they differ on one point, the point has probability 0, therefore I don't get a contradiction if they are different on one point. And then I'll have to say, yes, you're right. If they are only different in a set of measures 0, then of course it doesn't work. They have to be different in a set of positive measure. And then I get into a slightly more involved mathematical argument, but I think you understand where this is going. Yes? That's how you would do it. In the case of finite probability spaces, it's very easy, because every one of those events has probability bigger than 0, in which case, if they differ in one point, that's all I need to get to my contradiction. If I have an infinite measure space in which every point has probability 0, then I have to have a slightly more involved mathematical argument where I have to look at, the points where they differ more than a certain epsilon, and then, but you may have done these mathematical arguments several times. I'm not going to go through them here, and frankly, I'm not even interested. I'm only showing this to you so that for those of you who follow the argument here, you can see the depth of the pricing theories that exist. My intention is to not go beyond what I have shown you here. As I mentioned, this is not something that will get you a job anymore, but it is something that is edifying because it helps you see how pricing theories can be constructed. Okay? Okay, so let me then continue with an additional slide, which is the final point I'm making that connects what I'm doing here with the risk neutral measure. Note that under the assumptions in the theorem, the price of any portfolio can be given by the expectation of the payoff, the expectation modified by the state price deflator. I chose this slightly more convenient notation where the density that modifies the probability I use as a subscript of my expectation operator. So here, the expectation of a given random variable that I will call f now is, on the one hand, the expectation of the function itself multiplied by my original measure mu given to us, the 50-50, the real world measure, the wrong measure, so to speak. But then on the right, what we see is the expectation of f with the correct measure modified by the state price deflator that will give the price. So the expression on the left is not the price. That's when someone paid 50 cents to play our game. The expression on the right has the right price. That's when people paid 33 cents to play our game. The one on the left is wrong, the one on the right is right. So then we choose this expression to denote the measure, the original measure given to us as the real world measure, possibly wrong, and the expression on the right to be the risk neutral measure, which is always right. It always prices all of the securities that we have in front of us. The base securities, of course, but then any other payoff given to us. And for those of you who understand this, pi, that density, is the Radon-Nikodym derivative between the real world measure and the risk neutral measure. And as was mentioned earlier, there is some conditions about absolute continuity. These measures have to attach probability 0 to the same events. Arbitrage opportunities may occur if that's not the case. So the absolute continuity is a condition that is needed for this thing to work. And now the minute I start talking about things like this is when things can get very deep, technically deep, and is something that I, on purpose, will stay away from in this course. I just wanted to give you a glimpse on how these prices theories work. Okay? Okay, so is this understood? Are there any questions about this? This is not a theorem that you're probably ever going to use, most of you. This is not a theorem I'm going to require you to know. This is not a theorem that will probably get you a job, although, well, you never know, but it's unlikely. But it is a theorem of great significance. It is a theory that displays very well how pricing theories are built. And it's a theorem that we're just going to keep in our mind as we continue with all the other derivations that we will obtain. When we price credit risk, there's going to be echoes of this theorem that will appear, but there will be just echoes. We're not going to use this theorem in its form in this course again.
Can I ask, so my understanding of the theorem is mostly that in practice we want to be able to price things so that arbitrage doesn't happen, and we want to know if it's even possible. And so this basically says that it is if you assume the right stuff. And so it tells us that it's not unreasonable to try to avoid arbitrage. Is that one way to understand it?
I'm actually not sure if I understood what you said. So let me make an attempt to answer. And maybe I'm answering the wrong question. Maybe I'm not answering your question. Okay. This theorem, in the finite dimensional case, it does give us a way to calculate the state price deflator. It does. But perhaps more significantly than that is it tells us that there's always going to be a way to modify any measure given to you and make it risk neutral. And as you can see in this slide, given any measure to you, you can modify to make it risk neutral. So if in the 33-cent game, I tell you that the probability of the stock going up is 50% or 75% or 60%, you don't care. Any one of those probabilities given to you can be fixed, so to speak, with different densities, but there will always be a density that will price all of those that will price all of those securities. Let me take one step further. Let's go back to your first assignment. What did you do in your first assignment? You have a certain number of coupon-bearing bonds, and then you essentially have to find the price of the zero coupon bonds, which is what the yield curve is. If I had asked you to do the opposite, if I had asked you to look at zero coupon bonds and come up with the price of coupon-bearing bonds, that would have been very easy. But then when I asked you, no, go back, start with the coupon-bearing bonds and go back to the zero coupon bonds, and I told you that the yield curve will exist. Of course, we have the bootstrapping method, which is what you use to calculate the zero coupon curve. But now this theorem gives us another perspective on where that zero coupon curve comes from. Imagine that I have a universe of securities which are your coupon-bearing bonds. and give me certain payoffs. And I have prices. And now I give you a different set of securities, payoffs, whose prices I don't know, which are my zero coupon bonds. This theorem will tell me that this state price deflator that will price all of the coupon bearing bonds and the zero coupon bonds at the same time. In other words, in that context, the state price deflator is your yield curve. Okay? This gives you the construction of the objects, financial objects, that you will encounter anytime you want to price certain securities at the expense of others. I don't know if I answered your question, but what I told you is true. Did I answer your question?
I thought that was pretty good.
Yeah? Okay. All right. Yeah. Yeah, I mean, I could be talking about this for, a very long time. There's really a lot of things to say here. I presented you the fundamental theorem of asset pricing in the single period case. You can do the same thing in the multi-period case. What happens when you do this in a multi-period case? Every random variable I have has to be changed to a random process. And then at every point in time, you do exactly the same thing we did here. Big deal. I'm not going to do that. Okay? I think you have seen enough. I think you have some evidence on how pricing theories are built. If you ever had to come across the building of a pricing theory in this fashion, I think you can do it. You've seen the easy one. And I think this is how I would like to end my discussion on the single period pricing theories. Okay? Okay, if there are no more questions, what I'm going to be doing now is we're going to take a 10-minute break. And after the break, yes, go ahead, Kavya.
So basically, I wanted to know that what do you mean by real world measure?
Real world measure is, okay, the real world measure is the measure given to you. It doesn't mean that it's real in any way. If I tell you I have a stock and it could go up with a probability of 50% and down with a probability of 50%, that is just the probability that I give you. It's referred to as a real world probability because originally these were probabilities done by analysts. That's what analysts do. Okay? And one might think that you have to use those probabilities to price derivatives, to price options, or to pricing theories. We saw very early with the 33-cent game that those probabilities can often be misleading. Not only they will not price your option, in fact, if you look at it, they won't even price your stock correctly. Okay, so they're called real world, not because they represent anything real, it's because they are given to you, maybe by the analyst, maybe by something. It's just a term. It has nothing to do with reality. Risk neutral measure, on the other hand, those have meaning because these are the measures that will price all of your assets correctly. Why are they called risk neutral? Well, that's another exercise in financial etymology. They're called risk neutral because you price them without any regard whether the stock goes up or down. Risk neutral. Okay. In other words, these prices can always be hedged. You can always come up with a replicating portfolio. Therefore, it's a price that carries no risk. It's a hedgeable price. Okay. I don't know that I like either of these notations or either of these terms. This is a vocabulary discussion, but this is what is used. These are the terms which are used in finance. Real world is something given to you without any pricing characteristics. Risk neutral is one which is not given to you, is something that you construct. It has pricing characteristics, it has hedging implications, and it allows you to build replicating portfolios and hedge your risks entirely if you so desire.
Makes sense. Thank you so much.
You're welcome. Any more questions? We're closing the chapter now. This is the chapter of single period pricing theory. We're going to take a break. We come back. What time will that be? 12:30. And what I will do then is I will start to talk about multi-period pricing. We already, the slides will be uploaded to the website. Okay, I'll probably do that tomorrow. I'm still in China. It's very late here, so I'll probably do that tomorrow. But yeah, you'll have the slides. In any case, you have the slides of the original derivation that I did, which is much faster. It's only 2 pages. I decided to do a little bit longer with a picture, but it's exactly the same as what is already on the website. What I will do after the break is I will go back to the multi-period finance, which we already discussed. It was very simple. Today, I want to talk about a specific type of multi-period, which is not a simple repetition of the one period through backward propagation. We already saw that. I want to deal with something that I will call exotic options. I have an hour to devote to it. It's about right for what I want to do. And then that will end the single period and multi-period finance that we will do in this course. Next week, I will introduce the continuous time finance, which will lead to the black holes theory, and is something that is really important for you to learn. Also will not get you a job, but this used to get you a job 20 years ago, not anymore. But it's something that, as this theories, is something that is good to know, because they are part of the culture, the financial culture that we have out there, and also it's part of the language that is used for the pricing of many things, including the creation of financial artifacts such as volatility surfaces and other things. We will have to go through the Black-Scholes theory so we understand all of that terminology. But that will be in 10 minutes. I see you at 12:30. What I want to do now is I want to go back to the multi-period pricing, which we saw last week. We saw that the backfilling or the backward propagation algorithm helped us use the single period pricing theories into the multi-period pricing context. But today, I'm going to take that one notch higher. And I want to be dealing with certain types of derivatives where the extension to multi-period is not simply the backward propagation of the single period. There will be additional elements. And this is going to give rise to some of the interesting options that exist out there: the American, the Asian, the Bermudan, flexi caps, stuff like that. I will say something along those lines, but I want to keep it very, very simple. I want to price something which is fairly simple, just to make my point. As usual, this could be turned into an entire course if needed, but that is not the intention. The intention is to keep something fairly complicated simple, so you understand at least the complicated theories in their simplest setting. So I remind you what our pricing theory, multi-step pricing theory setting was. I'm going to write on my screen. When you when you have a certain stock that today is $1, actually at every point it can go up or down in value. It was very important that these trees were recombining. I remind you that if the trees are not recombining, the number of nodes grows exponentially, and then we'll run out of memory very quickly. And there's usually not a very good reason to do that. We prefer a Markovian approach, a process without memory, where when we are at this point, we don't know if we came that way or that way, and it didn't really matter. So this has very important practical implications. That's the one we're going to adopt. So if this is my tree process, all of it, with all of its 3 single period nodes, as we saw last week, these are 3 single period nodes. Here's 1, here's 2, here's 3. If this is my single my multi-period tree, what I can do is I can price an option or a derivative, for example, by doing what's called a backward propagation of that tree. We write a similar tree here to the right. I'm using the case of an option that has a strike price of 75 cents. That means that at maturity, $2 becomes $1.25, $1 becomes 25 cents, and 50 cents becomes nothing. Okay, these are the payoffs of my option under each of these three scenarios, so that we know. And then the trick was to look at each of these trees in isolation by looking at these pairs of branches. Here I have a stock which is 150, can go to $2 or $1, and I have an option that I don't know this is a big unknown, I don't know what that number is, but I know that if the stock goes up to $2, it gives me $1.25, and if it goes down to $1, it gives me 25 cents. So that's a European branch. We have seen that before, and we know how to price it. And the answer is not only that the price of that option is 75 cents, the answer is that I can hedge, or I can replicate this option by having 1 unit of the underlying and borrowing 75 cents. This is assuming 0 interest rates. Yes? So we know that. Great. And with that, we know the same thing for this particular branch, where you have a stock that is worth 75 cents, can go to $1 or 50 cents, and you have an option whose price you don't know. We don't know this. But we do know this, that the 25 cents or 0 if the stock goes up and down. As in the previous case, these two branches in combination allow me to find this, and also the replicating portfolio. So we're done there. And as we go back through this process, which is called backward propagation, we see that now we're at the position where this entire set in time has been revealed to us. We know what the option prices would be after a single period. This is now my unknown. We don't know this, but we know this. So once again, having the branch on the left and the branch on the right allows us to complete our pricing tree, getting a price for the option which is $0.33, and moreover having a replicating portfolio which will give me 83% of my stock, borrowing 50 cents from the bank. And we are done. This is how we do the pricing. Now, with the pricing, which is interesting, comes the hedging, which is perhaps more interesting. And now we can look at the dynamic hedging. This is dynamic hedging once we have the whole tree finished, because it tells me that I can, with this stock in mind, I can hedge this option by charging 33 cents, which I use to borrow 50 and buy 83% of the stock. And then I wait when the stock goes up in value. What I see from these numbers is that I have to buy some more stock. I have to buy a little bit more, so I have a full unit of the stock. I need to have $1.5 of the stock. Actually, sorry, I have to sell. No, I have to buy. Sorry, it's late here. Okay, so I'm making a mistake. I need to have a full unit of the stock. I have 83% of the stock, so I have to buy a little bit more. And when I buy a little bit more, I have to borrow a little bit more too. You can see that my loan increased from 50 cents to 75 cents. If, on the other hand, the stock goes down, we could see is that I release some of the stock, I sell it back, and I return some of my loan, and so on and so forth. This is what is called the dynamic trading strategy. It allows me to trade dynamically the underlying and the bond, so that at every point in time I'm 100% hedged. And this is how the multi-period pricing theory is done. It's as simple as this. But there's a catch. The catch is that this is a very simple example. This is a very simple example. We're going to be looking at examples where they're not so simple, and there's an additional consideration that we need to do, which is not a simple derivation of the single period finance. Okay, so for that, let me. Yes, 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 yes.
I understand this is just an example, but how could I buy, let's say I was doing this with one stock, how could I buy 80% of one stock?
Oh, okay, okay, right.
Can't I only buy units? It's a stupid question. It's
No,
not
no,
really-
no, 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 no. It's not a stupid question. It's a perfectly good question. Okay, so you cannot buy. In practice, you cannot buy 83% of a stock. Okay, you don't do that. Well, maybe you could, but it'll cost you a fortune. Okay, you have to go to a broker who will be very surprised, and maybe they sell it to you, but it'll cost you a fortune. The cost of this will be very high. So you have to understand what I mean by this. Obviously, no one is interested in playing this game for for really 33 cents, right? So this is just numbers which correspond to units which are a lot bigger than $1, say millions, right? So imagine that I have a certain option that will give me not $1.25, but it'll give me $1,025 at the expiration, or 0.25 million, which is $250,000, or nothing. This is more real now. And under that more realistic scenario, what I am buying here is I'm actually not buying 83% of a stock. What I'm actually buying, if the stock really is $1, stocks are not worth $1 million, they're worth $1. But if I'm doing this a million times, what I'm doing is I'm buying 833,333 stocks. That's what I would be doing. That's what these numbers mean.
Okay, that makes sense.
Yeah, good. Yeah. So I'll continue to use my poetic statements that I'm buying 83% of a stock. You know what I mean by that? Okay. Could be that. Look, in the case, I mean, some of you may enjoy this. In the case of fractional finance, and as you know, blockchains are one of their claims is that they can offer you fractional ownership. It is true. We could be in a situation where 83% could be bought, and then what I told you will continue to be true. But then you say, well, of course I can buy 83% of anything, because the blockchains which are everywhere may allow me to do that. That is not what I'm referring to. Okay, so here I'm not addressing the important topic of fractional ownership. I'm just expressing a very simple mathematical approach to what we're doing, where everything has been normalized to be about $1. So 83 cents is about right, the right order of magnitude. Okay, in practice, you will not do this for $1. You'll do this for $1 million. For $1 million, yes, but then that will be 833,000. It's a matter of picking the right units. I'm picking very small units because they're also easier to write. Okay, that's what I mean. Okay, good question. All right, so let me then go to the next example. This is the case of an American option. And what is an American option? An American option is the following. Imagine I tell you, same thing as the European option, okay? You can buy the stock for 75 cents, which is what I'm actually doing. I'm selling you the stock for 75 cents whenever you want, okay? At the expiration, it'll give you $1.25, 25 cents or zero. But if I really allow you to do this whenever you want, if you don't have to wait to expiration, and you can buy your stock for 75 cents, then imagine this. You can do this anytime. You don't have to wait. Let's see, can you do it now? So if you're here now, the stock is $1, and I say, I sell you an option, and you can buy it for 75 cents. Right? And would you do it? I know if we were in the classroom, I will take a show of hands. So instead of that, let me here in the chat, I'm going to open the chat. By the way, I usually don't look at the chat as I am lecturing. I am not a computer. I cannot have my attention divided between the chat and the lecture and my notes while I teach. I can see that many of you ask me questions in the chat while I'm lecturing. Sorry, I don't look at it. Okay, so, but now I am looking at the chat, and I would like to ask you Just to see if you understand the question, if I allow you to buy the stock for 75 cents, given what we have here, would you do it? No, you don't have to wait for expiration. Would you do it? The stock is $1. Would you do it? Would anybody buy the stock for 75 cents? Now, the stock is $1.
Yes.
You would buy. Okay, so it's a bit of a rhetorical question because I didn't tell you how much I will charge you for the right to buy the stock. What if I told you that, okay, great, you can buy it for $1, but you have to pay 33 cents for that right? What would you do? Everybody said yes, but again, it was a bit of a rhetorical question because I didn't tell you how much. What if I charge you 33 cents? Would you buy the stock for $1? I give you a right to buy the stock for $1. Okay, so you can buy the stock for $1. But now I say you will have to pay 33 cents for that right. Don't worry where the 33 cents comes from. I'm just telling you, I'll charge you 33 cents for that right. You don't like my price, go somewhere else. That's what I'm telling you. Would you buy the stock for 75 cents? No, you would not. No, you would not, because you buy the right first for 33 cents and then you buy the stock for 75. So that will make you 25, but you pay 33. You're going to lose money. You will not do it, right? So if I give you that option or that alternative, the word option is going to become now a little bit ambiguous. If I give you the ability to buy the option whenever you want, so to buy the stock whenever you want, or in other words, if I give you the option to exercise the option whenever you want, that changes your perspective, that changes your approach. In this case, you would not do it. Imagine this now, so that I know I'm using a tree that I haven't really explained very much, but at least it looks exactly the same as the one for the European case. We're used to that, so I'll continue to use that. Imagine this. What if we are here? Okay? Would you buy the option for 75 cents? Same question, yes or no? And now I can tell you that the right to buy the option for 75 cents will cost you 75 cents. Will you buy the stock? Will you buy the option to buy the stock for 75 cents? It'll cost you 75 cents. Would you do it? You will not do it. Well, what I would say is that since we live still in a world of no arbitrage, we live in a world where the efficient market hypothesis is true, we live in a world where we don't work for money, we work for free, I would say I'm indifferent, right? Because 75 cents for the right of exercise for 75 cents means I pay 75 cents. When I exercise, the stock is 150, I can buy it for 75 cents. I get my 75 cents back. So I don't make or lose any money. This is what I will call a point of indifference. Okay? And if we go to this point, would you, if I give you the right to buy the stock for 75 cents and the right costs you 12.5 cents, would you do it? I'm not going to answer. The answer is no, because you're going to pay 12.5 cents to get nothing. You're not going to do it, right? So here's the answer is no. Here the answer is no. And here, well, we know. Here you get nothing, and here you get something, and the price is exactly equal to what you get. So you note that the price is always equal to what you get. So in a certain sense, if that's the case, right? If you got experience, you say, will you buy the option to get 25 cents for 25 cents? You say, well, no. Or you could say yes. Again, we're still working for free. So from that perspective, this point is interesting because we said no, but maybe the answer should be yes. right? What's the difference between that and that? You're going to break even, so to speak, right? You're going to break even. Okay, let's look into that a little bit with some more detail. And let me make a definition. I want to introduce now a new type of option. And this applies to derivatives too, but most of the time this appears for options. We saw that in the case of a European option, the one that you can only exercise at maturity, we see that you have a payoff. The payoff is the value of the stock minus the strike price. Of course, when it's positive. When it's negative, you just walk away. You don't exercise, right? And now I give you the ability to do that. I give you the ability to exercise your option and buy the stock at a possibly cheaper price. And I do this at every point in time. How would you decide if you do it or not? Well, you would do it exactly as you did in my questions to you, right? You would say, well, what do I get if I exercise? And what do I get if I don't? Okay, that's what you did. What do I get if I exercise? What do I get if I don't? So if I go to this point, for example, but now I don't tell you what the price is. I told you the price would be 75 cents. Now I don't tell you what the price is. And my question to you is, imagine you're at this node. The stock is always the same. That's what the stock is. You're here, and then I ask you, you have an American option, and here, would you exercise or not? Okay, so the question is not to be or not to be. The question is to exercise or not to exercise. Would you do it? So if you exercise, and we don't know this price, okay? We don't know the price. So the question is now an honest, arbitrage-free question. What would be the price for exercise? If you exercise, you get 75 cents. So exercise will give you 75 cents. Not exercising will give you how much? Don't say zero. Because if you don't exercise, what do you have? If you don't exercise, what do you have? If you don't exercise, you have a European option. And the price is 75 cents. You understand what I'm saying? The word 75 cents appears twice, but they come from completely different avenues. My first 75 cents is if I exercise, I get 75 cents. I don't know how much I paid for it, but when I exercise, I get 75 cents. If I don't exercise, I also have 75 cents, independent of what I paid. So the argument that I'm trying to make with you now is an argument which is independent of what I paid. I'm not talking about whether you should buy it. I'm talking whether you should exercise it. So it's a slightly different question from what I asked you earlier. If you already have the option, you already bought it, it was given to you as a gift, doesn't matter. If you already have the option, how would you decide if you exercise it at some point? You have two options, to exercise or not to exercise. If you exercise, you get 75 cents. If you don't exercise, then it becomes a European option and you also get 75 cents, right? So what's the price? The price is 75 cents. Happens to coincide with my European price, okay? But that is almost a coincidence. If the price of not exercising would be higher than exercising, what would you do? You will not exercise, and therefore the price of the option would be higher. If the price of the option is lower than exercising, what would you do? You would exercise, right? Because it gives you something of more value than not exercising. And then the price of the American option will be higher. That's how you determine the price, and that's what is written here. Okay? The price of the
Professor,
yes. Go ahead.
yeah, I have a question though. So, if I'm correct, European options they can only be exercised on maturity,
Right.
and American options we get a freedom to exercise them whenever we want up
Whenever
till
you want.
maturity.
Exactly.
Yeah, but you have written here it is never optimal to exercise an American call option prior to maturity.
Yes.
However, many a times I have witnessed even in like real life scenarios that during periods of volatility, the the option fluctuates, and before maturity, while you might be in a profit, on maturity it might neutralize or you might even go in a loss.
Yes. Okay.
And
So yeah.
the ability to exercise gives us additional utility in case of the American option. So, can you explain why you say it's always
Okay.
optimal to
Yeah.
exercise on maturity?
Okay. So I didn't get to that part yet. I didn't get to the part of it's never optimal to exercise an American option early. Okay. But since you asked, let me tell you, it's not related to what I was talking about. It's something that's coming later. Okay. But let me address it. Let me address it now. The reason it's never optimal to exercise an American call option, okay? Put options are different. The reason it's never optimal to exercise an American call option prior to maturity is because this argument I just gave you, which I was about to finish, I'll finish after I answer your question. This argument I gave you leads to a pricing mechanism for American options, where what we do at every point in time is we evaluate two things. We evaluate the value of an action, which is exercise, is very easy, it's a payoff, and we evaluate the value of not taking that action, which is a regular European option, whose prices I already know. And then I compare the two. That's what I do. I do a comparison. And then I say, if as a result of that comparison, I take an action. As a result of my action, I come up with a price. That's how price formation works. That's what I was discussing. Okay. Now, after you do that, it turns out that there's a theorem that says that for an American call option, it's never optimal to exercise early. It's a theorem which is a consequence of another theorem that some of you may have seen. It's called the maximum principle. You may have run into maximum principles many times. They appear in many branches of mathematics. In this context, the maximum principle appears because, as we will see next week, the price of a European option is the solution of a certain parabolic differential equations. And a parabolic differential equation has the property that the solutions prior to, in this case, maturity, never exceed the value of the payoff. And this has as a consequence that it's never optimal to exercise. So when I say that it's never optimal to exercise, this makes a reference to a fairly sophisticated theorem, which we're not going to see. I'm going to tell you about that in a as my style is, in a more intuitive fashion. I'm not going to prove it to you, and that's why this thing is written here. I'm not there yet. I'm not there yet. This will be a result. However, we will see in all of the examples we're going to build that we are never going to come up with options that we exercise early. Never. In all of the examples. And you say, well, why is that? Well, there's an actual reason for that. It's not a coincidence. It's not that the problems that I put on my slides are all the same. They all have the same property because that property is actually a theorem, and that's what this refers to. Okay, but I try to converge to that statement slowly. Do you understand what I'm saying?
Yes.
Okay, good. All right. So let me go back to the act we are trying to express now. See, we're using pricing theory now not to price things. We're using pricing theory to act, to decide of an action, to be or not to be. That's what we're doing. Okay? And I want you to understand the elements that go into making that decision. If I exercise, I get a price. If I don't exercise, I also get value. Sorry, I said it wrong. If I exercise, I get not a price, I get value. If I don't exercise, I also get value. This is the value we've been talking for 2 weeks now, is the value of an option, which has value. And remember, we don't distinguish between value in an asset, value in an option, or value in cash. To us, they're all exactly the same, right? So to be or not to be will be very easy resolved in finance. You would just price the to be, you price the not to be, and you compare. Understand what I'm saying? Oftentimes, you're going to see that the to be and the not to be are exactly the same. In which case, it's a point of indifference, you do what you want. In some other situations, like here, exercise, no exercise. No, thank you, I don't exercise. You're going to cost money, then you don't exercise. And for American options, American call options, very often is, I don't exercise, I hold on, I wait. Going back to your question, well, we're going to see an example later. So, well, why? I waited, I could have made 25 cents and now I end up worthless, right? What happened? Why didn't I exercise? Well, the reason is, remember, we don't only just exercise, we don't gamble. You can always replicate a portfolio, right? That's why we don't exercise, is because the value of exercise may give us less than the value of the option. But of course, that assumes that we have a replicating portfolio. Maybe you didn't. So that's why you should not take these statements that we're saying here too far into specific situations, okay? Remember, every price we pay is a price we hedge. And that's why these theories work. Okay, so this is how American options are priced. And the backward propagation is exactly the same with an additional layer, which is that you not only have to price the European branch, you have to price the exercise option also and take the higher of the two values. Okay? Okay, let me go to something, maybe you'll understand when I go to something which is a little bit more sophisticated. And for that, I'm going to now talk about something which is called swing options. Swing options is a term which is, it comes from the world of energy and electricity in particular. And these are options that you have to either put electricity to the grid or take electricity from the grid. That's what they call swing. For us, although I will refer to them as swing options because of historical reasons, for us they're going to be very simple options, call options in their majority, but they have a slightly different behavior, which I want to explain. As I say here, they come from electricity prices. And to understand this, I want to use the example of an Air Canada flight pass. I don't know if any one of you has purchased an Air Canada flight pass, or if you know what they are. Do you know what they are? Have you seen them? Yes, no? Let me explain to you what they are. I have a screenshot from the Air Canada website here, but I'm not going to look at the screenshot yet. Let me express to you a reality that many travelers face. I used to face that reality. For many, many years, I had to go to New York very often. I had to go to New York almost every month. Okay, sometimes twice in the same month. That's when I was running my investment company, my manager, I had to go to New York very often times without knowing fairly quickly. And when you do that, prices of ticket prices can be very high if you don't plan your trip in advance. So I gotta go tomorrow, check prices. They are $1,000 each direction, very expensive. Right? But you don't have an option, you do that. Okay. Air Canada introduced what they call a flight pass, which is, I go to New York, say every month, I want to buy, say, 10 flight passes that last a year. So for the next year, I lock in a price to go to New York. Now, this is not a forward contract, it's not a futures contract, right? Because Air Canada doesn't force me to buy that flight at that particular price. I prepaid it and I decide when I go to New York if I want to use it or not. Let's say, I don't know, we have some prices here. Let's say that I want to buy, it says 10 flight credits. They're going to cost me basically $380 each way, right? That's what I pay when I buy a flight pass, $380. So I say, well, that's a very good deal. But let's say one day I can go to New York for $250. What shall I do? Shall I use my flight pass or shall I just buy at $250 and I save that flight pass for the next flight? What shall I do? That's a decision. And the decision to use a flight pass or simply save it is exactly the same decision we just saw with American options. Exactly. And that's what I want to show you now. Okay? It's another type of option pricing. It's an option pricing. Of course, they're financial, but where the analogy that we have with what we saw earlier, and even the theorem that we saw today, is unclear because we're pricing an action. Of course, an action implies a certain security, and in a complete market, there should be a derivative that prices that, and therefore you can invoke the fundamental theorem of asset pricing, and it should work in that situation too. The theorem we saw was very general. It applied to securities in a vector space. It was also very, very general, right? But back to the flight pass. I'm not going to do it in that setting. Back for how would we price that? And in particular, is it a good deal to buy a 10 flight credit pass from Air Canada for $380? Is that a good deal? That's what we're going to answer. Now, to understand this, let me say something. It's wrong, okay? It's wrong, but let me say something, see if you understand why it's wrong. This looks very easy. I have 10 flight credits. Air Canada allows me to fly to New York for $380. So what I do is, let's say I buy it, and then if one day the price is $250, then what I do is I look at the value of an American option for that day, because these flight credits are American options. They allow me the right, not the obligation, they allow me the right to buy not a stock, but a ticket, a flight ticket for $380, right? So what's the difference between a flight pass and an American option? They're exactly the same. I've agreed on the price, the strike price $380. I don't have the obligation. If the flight is $1,000, I will go for $380. If it's $250, I'll go for $250. And no, why is this not an American option? Who can tell me? Let me ask you another question. What if I had, it doesn't exist, look, there's 8 flight credits, 10 flight credits, because the strike price is an average. No, that's not the reason. The strike price is not an average. The strike price is real, right? It's $380, okay? But the thing is that I can buy 5, I can buy 10, I can buy 8, I cannot buy 1. If I could buy one flight credit, they don't sell them, but if I could buy 1 flight credit, it would be exactly an American option. It's exactly an American option if I could buy 1. Right? And then we have seen how you do that. You have to go to New York, price is $250, you can fly for $380, you already paid. What do you exercise or not? If you exercise, you made $120. If you don't exercise, you have a certain asset, you calculate the price, maybe higher or lower. You don't know. That's how you make the decision. We already saw it. So if it's an American option, we know how to decide if we buy it or not. We just saw it earlier. We applied instead to stocks, we applied to ticket prices. Okay, I'm looking at the chat. People are writing on the chat. Okay, so the reason is not, it is an American option if it's a single flight pass, but if it's 2 flight passes or more, it is not an American option anymore. Why? Because if it was an American option, if it's optimal to exercise one, it's optimal to exercise all of them, all 10 flight credits. Right? You don't save any for the next day. But you cannot do that. Operationally, you cannot fly to New York 10 times in a given day. No one does that. I'm sure there's someone who flies to New York twice in the same day. I'm sure that has happened. I would not be surprised, but we can eliminate that possibility in our discussion, right? The difference between an American option that gives you 10 opportunities to go to New York is that a stock, yes, you can sell 10 stocks, one stock, a million stocks. But when it comes to this, there's what's called a volumetric constraint. There's a volumetric constraint. You can only fly to New York once. Therefore, the value of a 10 flight credit should be less than 10 times the American price of a single flight credit. Do you understand that? This is important, and it is part of finance, but it's also part of insurance. Because what these contracts do is, in a certain sense, they give you insurance. They protect you, right, against prices going up. Imagine I don't know how many of you have, say, car insurance. Let's say some of you have car insurance. What if I told you, you don't drive on Sundays for whatever the reason? I say, well, if you don't drive on Sundays and you promise you will never drive on Sundays, maybe I can give you a discount on your car insurance. I'm not going to charge you more because you don't drive on Sundays. If anything, I'll charge you less, right? And in fact, if you agree that you will not drive on Tuesdays either, I'll charge you even less. Why? Because you are giving up rights. When you give up rights, you should pay less. Same thing here. You're giving up the right to fly to New York 10 times in a given day. It looks ridiculous, but from a financial perspective, flying to New York 10 times in a given day means that if one day the price is very low, you will exercise all your 10 tickets that day, and then that will create you value that will be translated in elevating the value of the flight pass. Okay? So this is why 10 flight passes is not the same as 10 American options bundled together. You can only exercise one per day. And that is what a swing option is. Okay, these are volumetric constraints. Go back to the world of electricity trading, for example. Swing options, in the case of electricity, is you can put some electricity to the grid or take some electricity to the grid, but with a limit. Otherwise, you would take all of the electricity from the grid if it was cheap to take electricity from the grid, right? Mm-hmm. Or if you had infinite capacity, you would put all of your electricity to the grid if you could. But these things have volumetric constraints. You cannot just do that. That's why these types of option trading with volumetric constraints are so common in the world of energy trading. But we're going to use it in the context of Air Canada and the flight credits. But now I'm going to try to model this using the pricing theory we have learned. We're going to climb a very steep hill, very, very steep, okay? The arguments I'm going to show you now are very complicated. It's only one slide or maybe two, very, very short, but it's very, very steep. However, we're going to learn something very, very powerful, very, very powerful. I think because of that, what I think I'm going to, what I usually do when I do this is I explain this and I let you think about it. And then I'll start my class next week answering questions. You're going to have to go back, think about this, and then ask questions in the next class. What I'll be talking about the next class has nothing to do with this, but this is, again, a steep hill. It'll take you time to digest, to understand, and then I want you to ask me questions next week. Let me tell you how this is done, okay? This is a to be or not to be, but at a higher level of complexity. Okay, so this is what we do here. I'm going to price what's called a two-up swing. Think of it as a two flight credit. One flight credit, we know it's an American option. Easy, we know that. But let's say you buy the right to go to New York twice in a year for $380. That's what you buy. I'm not going to use $380. I'm going to use a stock 3 or a fare fee, which is $1, $1.50, $75, and so on and so forth. And this is the evolution of fares going for the year. You can imagine that instead of having 3 time steps, I have 360. Or if you fly weekly to New York, I have 52 of these, whatever you want. But I'm going to use a manageable tree that I can put on your screen. That's where I use only 3 time steps. Okay? So 3 time units, 2 time steps. All right. So this is what I'm going to do. I'm going to calculate first the value of my what's called the one upswing. That's the American option. Of course, we've done this many times. We already know the answer is right here. That's the value of my American option. That's the one. That's a flight credit with 1 flight pass only. I do that first. You will see why. And then I have that price, and that price because it's an American option. And then I go back and I price it as we did earlier. It's an American option. And then I find the price of the American option is 33 cents. So in this case, what I just concluded, because it's a copy of the American option, is that if Air Canada is selling a flight pass that only flies to New York once, then you would pay 33 cents for that. Okay? And yes, by the way, you would be hedging this by buying a fraction of a flight pass, which you cannot do. But you understand? Again, this makes sense when you do many things and you multiply by big numbers and then everything makes sense. But we're going to go back to our comfortable world of a single dollar. So the American option is what it is. It's very simple. And as usual, although I know it's never optimal to exercise, I remind you that we will use that flight pass to go to New York for $380. We will use it when the value, when the savings exceed the asset that you would hold on to if you hold on to your flight pass and you pay whatever amount of money you have to pay to go to New York. Okay? That's the tricky part. See, okay, is that clear? To exercise or not to exercise is a result of calculating the value of exercising, the savings, and the value of the asset if you hold on to the flight pass. The flight pass will change in value over time as dictated by this tree. So at every point in time, that flight pass will have a different value. If tickets become cheaper and cheaper and cheaper, then the flight pass will become cheaper and cheaper and cheaper. And then you will eventually exercise. Say, well, my flight pass is so worthless now that I'm not gonna exercise. I'm just gonna buy the ticket. Or prices may become very expensive, and they say, well, now the payoff I get, the savings are so high that is still worth more than my flight pass, and I'm going to exercise. Okay? That's how you do it. All right, so that's the one flight pass. But let me go now to the several flight pass. if I have a, actually this is the same, hold on. No, sorry, this is the two option, okay? So if I have two flight passes, what I'm going to do is at every point in time, I do the same thing. I say I have two flight passes and I have to decide if I exercise them or not. If you exercise, what do you get? Well, you get the strike price subtracted from the ticket price. That's your payout. But that's not the only thing that you have in your payout. What do you get if you exercise? You get that plus, now you have a single flight pass left. So it's not only that you save money, that's your savings, it's that you have a flight pass left that has a price. What price? The price in the American option we calculated in the previous slide. So it's a sum of two things. If you exercise, you get a sum of two things. This is what you need to understand. I get the sum of my value from exercising and a new flight pass of one flight less. The sum of that represents the value of my decision. If I don't exercise, what do I have? If I don't exercise, what I have is a European branch. And those we can price because I'm not exercising, so I price them using backward propagation. You understand? This is the key that you need to understand. If you had a 10 flight pass book with Air Canada, then if you exercise one day, the value will be the savings plus a book of 9 tickets. You see? How much is the value of a book of 9 tickets? Well, we don't know. That's why in this case we do a backward propagation where we actually start backward propagation with the American option, 1 flight pass, then the American option with 2 flight passes, then the American option with 3 flight passes, and 4 and 5, and so when I get to 10, I would have already done the book of 9 tickets. So the act of exercising means savings plus a book of 9 tickets, which I've already calculated. And then I can make the comparison, because if I don't exercise, there is a European branch, whether I have 10 tickets or 11 tickets, it doesn't matter. It's a European branch. I can always calculate those. And this is the key. This is how you do this. Let me show you. This is the value of my option at the expiration. It's always the same. I have 2 tickets left. I can only exercise 1, so it doesn't matter. The value is the same. Strike price is 75 cents. Stock price is $2, $1, $0. So the price of 2 tickets or 1 ticket is the same. I can only exercise once. Okay, so that's done. We know that. Let's go here. We're going to go for backward propagation. When I'm here, my stock is $1.50. And I can exercise for 75 cents. When I exercise for 75 cents, what do I get? I get 75 cents from the exercise, and then an American option that is worth 75 cents. The sum of the two values is $1.50. So if I exercise, I get $1.50. If I don't exercise, what do I get? If I don't exercise, what I have is my one upswing, my American option, which is worth 75 cents. So here's very clear. If I exercise, I get $1.50. If I don't exercise, I get 75 cents. Because the European branch is worth 75 cents. Do you understand? So in this case, you exercise. That day, when you go to New York, you use your flight pass. How about here? Well, my stock is 75 cents. If I exercise, I get nothing. And a book of one ticket, which is worth 12.5 cents. And if I don't exercise, I have a European branch. The value is 12.5 cents. So I'm indifferent. This is a point of indifference. It's clear because I get nothing for exercising. Okay? And then when I go here, what I have is, again, the decision to exercise or not to exercise. If I exercise, the stock is $1, I get 25 cents. And then the value of an American option, which was worth 33 cents. 33 plus 25 cents is 58 cents and a third. If I don't exercise, I have a European branch. I calculate the value and the value is exactly the same, 58 cents and a third. So it's another point of indifference. And that's how you use option pricing to make decisions.